All right. Second week. By the time you see this video, you'll realize that I couldn't do collaborate this week. I've got to go to flying to Georgia tonight, like middle of the night, and get there. I've got to go down there. I've got two daughters, one of which goes to Auburn, so she was in my custody, but she obviously is now at school. And then my second daughter, I'm trying to bring her up here as well, so it's kind of urgent to get down there for a court deal Wednesday. So anyway, gotta go tonight in order to get there on time. So it kind of popped up. They wasn't going to go, and now here I am. So anyway, it shouldn't affect us much. We'll get back on collaborate next week, and we'll move on. This week, there's tax planning and money management type stuff. A lot of it, well, maybe common sense, may not be. There's always some students that are have thought about this stuff a lot, and then there's others who have got other things going on in their life right now, and it's not a big deal to them. But I would argue that it's going to be a very big deal to all of you at a certain point, and so we'll talk through it. And there's some things in the book, and that are good. There's also some things that I don't normally think are realistic, or at least not for me. Each to his own. There's different ways to budget and do things like that, and whatever works for you. The main thing is that you have a plan. The do nothing approach is not a good one, because it's not going to work for you. Objectives, relationships between documents and how to do balance sheets and things like that. And again, the utility of a personal balance sheet, yeah. Sometimes, if you're getting a loan or something, but they're going to have specific forms for you to fill in. You can create a balance sheet, a cash flow statement, just to keep track of it for your own sake, and we'll talk about how you can do that tonight. And then implement a budget, and relate money management and savings to achieve financial goals. So, the important thing with money, from the get-go is not to obsess over it. But in order not to obsess over it, you got to spend some time on it, so you don't end up in a situation where you're forced to obsess over it. So I'm not, I've had friends who, particularly in relationships, where the guy would walk through the door and it's like, how much money did you spend today, and receipts and all that, and it's like, wow. Anyway, I don't think that works for most folks, and or even individuals. If you are that kind of person, more power to you. But for me, I tend to look at things more retroactively. In terms of a budget, I tend to look at what happened last month and figure it out. The advantage to my version is that it's pretty easy to do, because I tend to use a credit or debit card for just about everything. And then when you go back to look at what your spending was for the previous month, you also have a chance to look for things fraud-wise. Over here, in the United States, it's not such a big deal, but things will happen. In Spain, for example, they used to have these things. They were like fake ATMs, and really, you would go in there, and you need an ATM. You punch your card in, punch in your code, and it just says out of order, no funciona, whatever, because it was Spain, and it wasn't an ATM, and all it ever said was out of service, basically, and all it was a card reader, and you just typed in your PIN too. And so anyway, the folks who put that little kiosk up or whatever, they're already hitting your account, multiple times, running up to the limit. So there's some nasty things out there. Now, we'll talk more about this in other chapters, fraud and stuff like that. But usually, debit, credit cards, you can get it taken care of. Credit cards, you can pretty much always get it taken care of, because there's legal requirements. Debit cards, a little fuzzier, because it has to do with the agreements of the bank, and there's not as many laws involved. Credit cards, fraud is, you're protected. So, well, let's go back and talk about this. Money management, day-to-day financial activities. So just a quick definition. Opportunity costs. When we're talking opportunity costs in personal finance, what we mean is that if you spend on something, you can't spend on something else. If you ring up your credit cards and now you're paying a whole bunch of money in interest, or student loans, sometimes it's a necessary evil. You need to finance your education so that you can make more money at a certain point. But there is a trade-off. That money that's coming out of your pocket for really interest payments is money that you can't invest, or just spend on common things. And then also, I use the example of Starbucks, but whatever your are your vices in terms of spending? Going out to eat all the time, taking vacations that are probably maybe outside of your means. That's going to have an impact on what else you can do. And this isn't, of course, on shopping and things, but a lot of times you can have it. I mean, I've always had, when I was overseas, I always had Corvettes and Vipers and different kind of flash cars, and I never lost money on one of them because I bought them smartly and sold them well. But I wasn't buying brand new ones, and I was buying them. Well, also, if you don't have mechanical skills, don't go down that road. But if anything bad happened to them, I could fix it myself, and it wasn't catastrophic. But anyway, you all know how you shop and all that kind of stuff. So I'm not going to preach to you, but just keep in mind if you're spending on one thing, you can't spend on another, and that's the essence of opportunity cost. Components of money management. So storing and maintaining personal records, creating personal financial statements. If you need to, a lot of times all you have to really do is save the ones that you use to buy your home or file for some credit thing, and you'll probably be good to go. Creating and implementing a plan for spending, and that's really the heart of budgeting. Items in your home file, employment records, money management, tax, consumer purchase. The list goes on, but the advantage you have now is most of your banks, especially if you deal with the same one, and financial institutions, all that stuff's available on PDF for like 3 years out. So you can just download it and save it in a personal file, or if you're a trusting person, you can leave it out there on the internet. But better off when it gets to be tax time, download all your balances for the year, or all your statements for the year, and save them electronically, and it's far better. So outside today, so excuse the birds, the airplanes, all the other distractions, but I'm preparing to get on this flight tonight, so I got 4 dogs inside that are about to drive me nuts. Items in the safe deposit box. Okay, maybe some folks have safe deposit boxes. I've in class I've asked people these questions, and even trying to find a bank that does that anymore, it's kind of a lost type thing. For most people, being in Alaska, a lot of people have gun safes. Well, better yet, make sure that gun safe is fireproof, and maybe you can get some double duty out of it. Or maybe you have a separate safe that's just like a document safe. And I'm not talking big money. We're talking $30-$40, to get a small fireproof thing that's not ultra secure. And then obviously a big safe can get obviously pretty damn expensive. But some of these things on here are just completely dated, like down at the bottom, stock and bond certificates. Okay, I buy stocks and not really bonds, not at this point. The economy's not right for bonds. But anyway, I've never had a stock certificate. If you're holding a stock certificate, I wouldn't want to say you're an idiot, but I don't know what else you would call somebody. I mean, why would you hold you don't need them, and you don't want them. I mean, that thing is perishable, and the brokerage firms hold them for you. So I've never, I've seen like some antique stock certificates and things like that, but there's no need for that. Now, coins, other collectibles, that's a whole thing in itself. If you're one of those folks who collects those things, but that's not me, but again, you'd have to be protected. But these other things, everything above there, you need a file for them, preferably a fireproof thing. Whether they go in a safe deposit box, maybe not. Or, copies of them really aren't going to suffice. So, but anyway, there's certain records that you need to keep a hold of, and I think for most of us it would be some sort of fireproof safe, and maybe not storing valuables and birth certificates together, because if they take the valuables, they're just going to have a bunch of paper junk that's junk to them but very valuable to you. So anyway, records on your computer. So checks written, that's the beauty of the internet now. You can go right online and get, photocopies basically of the checks. You can even scan them in. So all that stuff has changed. Again, debit card records and credit card records are kind of a beautiful thing, because it does keep track of what's happened, and also if there's ever a dispute over whether you paid for it or not. If you use cash, you might be out of luck unless you've got a receipt. Um, Debit card, credit card, typically 3 years minimum is where that's going to happen. The income tax returns, I would advocate, and I'm not going to mention a specific brand TurboTax, but um, they keep them online for like 3 years at least. So you can download, um, you know, previous years and take a look at them, and it's number one, it's much easier because when you start the next year, chances are you haven't moved. Obviously, your social security number is the same, and you can look at the previous year. So I would be, well, I am an advocate. I mean, I've been doing it for since they've been out there, the tax preparation online, and I've had pretty good luck with it. And it does again keep all that record keeping, and in the process of assembling everything for the tax records, all that stuff's in a PDF file. So that is essentially taken care of. Again, don't leave it on a single hard drive. You may want to burn a CD and put that in with your stuff, or even a thumb drive, whatever have you. But everything on a primary hard drive is kind of a scary proposition. You should have some sort of backup of it. How long do you got to keep it? Obviously, birth certificates and stuff. You can get those things back. And wills, they need to be changed now and again. Social Security, you can go downtown and pay whatever amount of money and get it. Get a new card. That's not a huge deal, but documents related to purchase, sale of real estate, yeah, pretty important. Overseas, like a Spanish house or my German house, stuff is archaic. If you lose those forms, it is literally thousands of dollars and court time and all that to get it all recreated. In the States, not so much. A lot of that stuff's kept, um, by the outside agencies, and you don't keep it personally. And tax returns, yeah, you can get audited, or bad things can happen for out to 6 years. So anyway, every 6 years I kind of have a party because I can no longer be held responsible for what happened back then. Purpose of personal financial statements. So, okay, again, this is it might be useful to you to draw these things up and see where you're at. Again, if you're going to be doing, making a large purchase, they are going to kind of have you create these things. And if you already have a personal copy, then it may just be a cut and paste type thing. So there might be some utility there. But a lot of these things, again, I don't like to obsess over finances, because it's, finances are kind of like food. I mean, if things are taken care of, you don't really need to deal with it all the time. It shouldn't be such a huge part of your life. A balance sheet where you're now, net worth and financial planning. So assets, are the positive things that you own. Liquid assets are cash and things like that. Illiquid type stuff, I would put real estate into that category. Personal possessions, what are you gonna do? Put it all on Craigslist? It's kind of tough to liquid is cash, stocks, things that I can turn right then. Now stocks, the downfall with that is I may not want to sell them. I can always sell them, but the price might not be right. But when you're looking at real estate, you also have to look at market value. And I technically own my own home, but do I own it? No, really, the bank owns it. So the only part that's mine is the equity I have in it. So keep that in mind. It's not, you may live in a $400,000-$500,000 home, but unless you have that kind of equity, it's not truly an asset for you. Liabilities, the bad part. This is what you own. So current liability, stuff that's due in less than a year, and then long term is maybe a mortgage, something like that. And net worth is assets minus liabilities. So insolvency, as you know. So you've covered this in other courses in terms of like maybe corporate finance or other things, but this also applies to personal situations as well. But this inability to pay debts when they are due, that really gets down more to cash flow. You can have a whole bunch of stuff, but things are only worth what somebody's willing to pay you for them. And if you've got bills today and things that you haven't sold, you don't have cash, then you can have problems. So how do you increase your net worth? Increase your savings, reduce spending, increase the value of investments, reduce the amounts you owe. So anyway, nothing real cosmic there, but the increasing your savings is that, like I say, there's a concept we'll talk about: pay yourself first, and that'll show up even on the test. And the concept there is that when you're first paid, whatever amount you put, ideally, five, better 10%, and you just consider that as a bill, and it's done. Day one of your paycheck, and then you get to spend the rest. So you don't have to obsess about your budget as much, because if you've already put away your savings at the first of the month, then the rest is yours. And don't be stupid, but it's much more fun when you don't have to put money away at the end of the month. There's two reasons you don't want to do that. Number one, it doesn't work. I'm going to save what's left. That's a strategy that's pretty much going to fail. And you could still employ that strategy if you end up with extra money. You could still maybe put that extra money in an investment. But at that point, you might actually put it in a well, might not even call it an investment. Buying stupid things like Twitter stock or something like that. I mean, I made not a bunch of money, but a fair amount of money on Twitter, and but I would not classify that as an investment, because it's all over the place, and it doesn't have any real, whatever the value of that is questionable at best. So reducing spending, a good way to do that is by not ringing up your credit cards. I mean, that is the worst kind of spending of all, is that interest debt that just eats you alive, and especially when it's credit cards. So don't do that. Increasing the value of investments and possession. You have to invest wisely and reduce the amounts you owe. Pay off your bills. So cash flow statement. So total cash received, cash outflows, cash surplus. So again, cash flow, that can cripple you if you don't have the money to cover your current bills. You can have a whole lot of assets, but you may lose it all because you don't have the cash flow to support your current needs. So what goes into a cash flow statement? Income, wages, savings, gifts, grants, child support, all that good stuff. Outflows, variable and fixed expenses, obviously. And the difference between those two is the cash flow. So a spending budget is a spending plan. Live within your income, do the rest of that. Again, I've told you my strategy. If you don't have a budget at all, and you've never put one together, you certainly might want to. But if you're like most people, and you find yourself running a little short of cash at the end of the month, I would think it's a good place to start is reviewing and see what happened the previous month, where it all went. And again, that's a good check for fraud, and it's also you find out truly what things cost in terms of a cumulative type thing over the month. I mean, fuel, I don't know how much I spend, but over a monthly period, it's fairly eye-watering, because I have to drive a fair amount with work and stuff. So, characteristics of successful budgeting, well planned, realistic. A lot of times this gets back down to this relationship type thing too, where you're in a relationship. One's a spender and one's a saver, and it's going to be a source of conflict. So maybe a budget is a device to sort of go, okay, we need to talk, and this is the best way to do it, rather than just walk around in a funk the whole time, to actually have details on paper and be able to talk about it. Again, personal stuff for you. Selecting a budget system. So mental budget, that's not really much of a budget. Physical budget, envelopes. It's got an anal. Spreadsheet. Now we're getting better. Something like Excel or Quicken or something like that. Quicken's good, but I've never kept up with it for more than 3 months, and then it just kind of falls apart. So online budget, you can use Mint and things like that will do that stuff, and then a budget app using your iPhone. So again, whatever works in your particular category. Money management goals, we're using for savings. So again, kind of a nest egg. The other thing, the smartest thing to do is get the balances on your credit cards down. Okay, so that's going to minimize and again, when emergencies happen, that's why you want those credit cards. But again, you get it down to a manageable amount. And then what that does for you is when you do have a problem, so rather than have a bunch of cash sitting around to, fix your car if it breaks, if you've got a credit card with that's essentially paid off, and you got, fairly available, large amount of credit available, then you can, there's kind of your nest egg. Still probably should have some cash, but less is required, because idle cash that's not a good idea either. That's not an investment. Cash is just eroding away with inflation. So, and then that comment I put in there, buying's more fun when you actually have the money. I mean, it's just you want something nice, new, and you go out and you put it on a credit card. It's like, it's kind of bittersweet, because it's like, especially like a car or something like that. A car payment on a brand new car, yeah, you can live with it. It's brand new. But when it's 5, 6 years old and you still got that same car payment, you got maintenance, and it's a beater now, that's no fun at all. So, savings techniques. So payroll deductions. You can go to a mutual fund company and say, want to start up an account, and that's easy. Just go online, look at somebody, whatever your choice is. Fidelity. There's tons of companies out there. I've got one through my bank also offers stuff. Go to Morningstar, and that's a sort of a resource for picking mutual funds. Anyway, they'll have all the names, contact information for all the different companies. And, you call these folks up, they send you a prospectus. We'll talk more about mutual funds later. But anyway, part of the deal will be, it may be, say, $1,000, $2,000 to get started on one of their plans, unless you sign up for some sort of automatic payment deduction, and then it's like, maybe as low as $25 a check. And so that's what you want to do. And then that stuff just adds up. And it's that whole pay yourself first thing. That money's already spent, so you aren't going to spend it on anything else. 401k, this could be sort of the same thing. Maybe that's where your money is going. We'll talk more about 401ks, but what it is 401ks, 403bs, thrift savings plans if you're in the military. Those are all tax deferred. So what that means is say you're making whatever amount, say, sometime in the future, you're making 100 grand and you're putting 17.5 or something like that, 17,500 in 401k. Well, when it comes to tax time, it looks like you're making 82,500. So you only get taxed on that amount. In that other amount, that when you're 401k, it's tax deferred. With the theory being that when you retire, you're going to be in a lower tax bracket because you're retired, you're not working, and so your only income is going to be that 401k, so the tax you pay on it there will be less. So coins, make periodic deposit. I don't deal with coins. Whatever, they go in a jar, and I just use credit and debit cards and don't deal with them. Write a check each payday if you want to do it that way. I still think the electronic thing is easy. And again, they'll send you a statement at the end of the year, and you're like, whoa, that's a lot of money. And then all of a sudden you'll see the interest start building up, and it'll get kind of addictive. And I guarantee you will not miss, especially if it's a reasonable amount. And if you want to up it, cool. You can do that. But I think actually after a couple of years, it'll be so addicted that greed will set in. And you'll have to settle yourself down and not, be taking 20% of your paycheck or whatever to do it. Now, 401k thing, and we'll talk about this later. If there is some sort of matching with your employer, do it. So that's a huge deal. Any matching deal, you want to max that out completely. But we'll talk more about that as we go. Whew. Money management plan. Yeah, 401ks, especially with matching, view system, itemized statements. Yep, and I've already discussed that. So these are the problems. 10th edition, 11th edition. So whatever, they added a few more pages in there, but the content's about the same. So the problem sets are the same. All right. Now I'm going to jump into planning a tax strategy. Taxes, they're a necessary evil. They, obviously they sustain a lot of good things and some maybe not so good. But the way the system is set up is that, you are basically, you're basically nothing more than a rat trying to get government cheese. You're trying to take the path to pay the least amount of taxes you can, and that's by design. The people call them loopholes and other things, but really it's things that the government or folks have decided are good for society, like home ownership. it's a good force. It stabilizes things. Giving to charity, all those things are tax deductible. So that's what you're trying to maximize. Um, so anyway, some of the objectives here: importance of taxes, calculate taxes, prepare federal tax, and tax strategies. So again, 1/3 of each dollar goes to pay taxes. So you think about it. You get taxed on your income, and then you go to buy something, you get taxed again, and then there's some corporate tax that's hidden in there that made the price higher. So when somebody says, "Oh yeah, you can get free health care," there's nothing free about it. It's the most expensive health care, perhaps. But anyway, different course, different situation. But keep in mind that essentially you paid for these things, and so you should benefit from them. Um, the thing about taxes is everything kind of freezes at the end of the year. So, this whole, oh, I should have done this, or I should have saved more, I should have, you know, put income in a different year. You can't do that once the end of the year hits, once December 31st. So, if you're going to use something like TurboTax or Tax Cut or anybody, if you've got a tax advisor, if you're in that kind of situation, talk to those folks before the end of the year and do sort of a trial run, and then go back and finish it off after the April. So it'll make the whole situation a lot less painful, a lot less stressful, and you'll still have time to act. So, but that's not a strategy. If you wait till April and you go, oh, what am I left with? That's you're stuck with your choices or lack of choices. No current laws. There's people. I guess it's Donald Rumsfeld, the old Secretary of Defense. He always puts a letter in there saying there's no way I can explain these tax codes. There's no way I know what I'm doing. Here's my best attempt. And he puts that because literally taxes are so complex. Um, the thing about some of the online or whatever computer tax software, it allows you to do different kind of what if scenarios and figure out where you're at. When we're back in class or on Collaborate, I will show you live, some of the tax things we can do, and just show you kind of the implications. If I rent a house or if I buy a house, huge difference. So nobody's saying not to pay your fair share. That's tax evasion. What we're talking is just tax strategy. So different kinds of taxes. Property tax or sales tax. So if you're in Anchorage, woohoo. If you're in the valley, it's a little bit, but it's not like the lower 48 where it's 10% generally. Real estate, property, personal property. Again, we don't have to deal with as much personal property. We do have a lot of real estate taxes. Taxes on wealth, sometimes when there's transfers, and don't expect those to go away. Taxes on earnings, that's what we're used to. You're used to seeing your check go away. And Social Security taxes, it's actually correct to call it a tax because for most of you, it's going to be means tested, which means your income's going to be considered before you get a dime of Social Security. So that's largely just a tax. For most of us, none of that money's coming back to us directly. Income tax fundamentals. So tax table, yeah, it's these tax, whatever. All this stuff is done generally. You can get books and you can look on graphs and all that kind of stuff and figure out where your income is and where you fall. But for most of us, you punch in the numbers and it shows you via computer. So again, if you have time, you look at multiple sources and different options to come up with what's going to be your best plan for you. Different taxes too. Earned income is like your salary type stuff. Investment income is taxed typically at a different rate. That's from investments. Passive, certain investments you can't be directly involved in the management because you don't want to be. You don't want to be liable for certain losses and things, so you can only have passive involvement. That's a tax strategy. And then other income. If you haven't done your taxes before, you will see that there's a whole category there. If you win something in a casino, you win the $1 million, you don't get $1 million. They actually withhold it right there before they actually hand it to you. Not that I've done that, but I've been there, seen it. Total income is affected by exclusions. So exclusions are not included in your gross income. So, tax exempt income, if you have like tax exempt bonds, something like that. And then we talked about tax deferred. That was the 401k or traditional IRA type stuff. We'll go into much greater detail on that. Anyway, adjusted gross income is, after you've made certain adjustments. So alimony, student loan debts, certain things that are that tax deferred investment plans, like that adjusted gross income where I said you made 100 grand gross and then it jumped down to 82.5. That 82.5 is your AGI. And then there'll be other reductions. But your goal is to get that down as low as possible so that your taxes are lower. And then tax deduction is subtracted from the AGI to arrive at taxable income. So we'll talk more about tax deductions versus tax credits. Two different things. You want credits. Deductions are nice, but they're not as powerful. You can also do the standard deduction, but for most of you, hopefully you'll get to the point where you're doing itemized deductions. Medical, dental expenses, yeah, and these are uninsured ones, so it's pretty, you're not in the best of shape if 7%, 7.5% of your income is going to medical and dental expenses. Hopefully you won't be in that situation. Taxes, mortgage interest, and contributions, all that comes off. And then miscellaneous expenses, if they're over 2% of your adjusted gross income. So they have to hit a certain threshold, but for most of us, you'll get right there, and you'll want to maximize your deductions. So when somebody says, gift to charity is tax deductible, what they're meaning is that that's going to come under the contributions there, and your income's going to come down a little bit. Subtract exemptions. So exemptions are the people. Again, it's going to put you in a different level depending upon, whether you're claiming yourself, your children, your spouse. And then you calculate the tax you owe. So there's a concept of a marginal tax rate. So when somebody says, oh, I'm in the 28% marginal tax rate, what that means is that there's different tax rates. Let's say on an initial amount, you'll be taxed at maybe 20%. Somebody's only making 30, 40 grand. It'll actually be lower, and sometimes they'll actually be getting paid money rather than paying taxes, which is kind of odd. But anyway, as you get up in income, and let's say you're above 80,000, and the next bit, say you're making 85,000, so all of a sudden let's say the tax rate starts, the 28% tax bracket starts at 80,000, up to 85,000, so that 5,000 between 80 and 85. You're in the 28% marginal tax bracket for that, and so that is the point where you'd be paying the 28% on that just marginal amount. On the lower part, your first 80,000, you're paying a lower tax rate. So, and because this gets all complex and convoluted, then you would figure out an average tax rate. Okay, if I'm paying 28% on this higher amount, and 20% on this in between, and 15 anyway, you come up on that average tax rate. Do you care? Do you have much control of it? Not really. You're gonna, use the strategy to minimize your income on paper. Obviously you want to maximize your income that's going to end up in your pocket, but in terms of the IRS, you want that to be as low as possible. And here they're talking about average tax rate, so they've got it down to 10% because the poor guy's only making 30 grand. So if you're getting a large refund, people act like, oh, I'm getting money back from the government. Now, sometimes if you are, truly in the poverty level, maybe you are getting money, maybe it is some benefit. But for most people, if you're a regular income earner and you're getting a huge check back at the end of the month, you screwed up. You are basically that money that the government's been withholding from you all year long it's your money, and they aren't paying the interest on it. They're just going to give you your check back. So don't do that. Again, this gets to the fact that you want to do sort of a trial run of your taxes and make sure everything's about right. And if you are going to be paying an overage, you can adjust your deductions up, which would reduce the amount of money you'd be paying. So again, you would talk to a tax professional, not some instructor on the internet. But anyway, you can adjust your deductions, which is a common means of lowering the taxes that's going to be held from your check so that it matches. Now they get all let's just say upset um, if you don't withhold enough, and if you end up paying a huge amount, then yeah, then the IRS is going to be mad, and they're going to assess a penalty. So you want it about right, and as long as you're in the ballpark, nobody's going to scream. And if it's driven by some unusual event, then again the IRS is going to understand that too. So now tax credits. Tax credits are much better than deductions because credits, are a one for one thing. So $100 tax credit reduces your income by $100. Tax deduction, if you're in the 28% tax bracket, it only reduces your taxes by $28. So say you donate an old beater car, well, maybe a better than beater car, it's $1,000. And they say, oh, it's tax deductible. Are you getting $1,000 credit for that? Well, you're not getting $1,000 credit. You're getting a $1,000 tax deduction, which works out to $280, lessened off your taxes. So it's a different thing. Tax credits are usually for, well, here you go, foreign taxes. Tax they have to pay to other countries, property tax in Germany in my case. Um, Adoption expenses, mortgage interest, energy savings. Again, it's like I say, the government cheese thing. Things that they want you to do, they will, make incentives, try and encourage that behavior by offering tax credits. W-2 form, that has your withholdings on it. Again, you'll see all these forms, and you've seen year after year, I'm sure. Filing status, you have some flexibility in this in terms of, how you can do it. Obviously, you're single. But you can, and believe me, when it gets too screwed up, people will get married and unmarried throughout the year, or once a year. And I mean, I know people who've taken vacations based upon changing their filing status and just kind of gaming the system. But this whole head of household, married type stuff, and when you want to do that, again, or your situation's changing, it's real easy to do in TurboTax, and you click that box and you run a calculation. You click it as married filing jointly, married filing separately. You can go through all those different iterations to figure out which one's going to be most advantageous for you. So do that. 1040EZ, yeah, this is kind of like, whatever. Hopefully you'll be beyond this, because again, you're leaving a lot of money on the table. If you're a normal kind of income earning person, and you've got a house that's deductible and everything else, this is good when you're, just starting out and, you're in college, whatever. But if you're, once you start making income, it is more than likely costing you money by doing that. 1040A, less than 100 grand, adjustments to income allowed, some deductions, but the 1040 is what you're probably, that's what I've been filing since I was at least whatever in early 20s. So because that's where you itemize your deductions. So cheesy stuff, dry cleaning, professional books and expenses, whatever it is that's related to your employment. A lot of stuff's deductible. So anyway, you're gonna knock all that stuff out, and you're gonna end up with a and I'm not saying it's cheap, but I'm just saying that your bill is ultimately going to be lower. So 1040X, you've been bad. So, or amend a previously filed return, but again, something screwed up there. Summary of tax calculations. So again, we talked about that. Sign your return, electronically signed in most cases. I haven't actually signed a physical. Actually, I've had some cases with foreign real estate where they want me to, hard file copies and mail it in, which is no big deal. Again, I use the online stuff, and then I just hit print and mail it to them, and they're happy. And anyway, no problems thus far. You can look at all the IRS regulations, but I would also advise you to look at some of the, again, reputable people, Ernst & Young's tax guide or other people's tax guides or something, but look for something in kind of explainable terms that's probably not written by the IRS, and then verify that is the case from the IRS publication. So you really got to do two things. If you go directly to the IRS publications, you're probably just going to get lost, and it'll give you a headache and everything else. You might want to look, especially if it's Ernst & Young. I would trust those guys. Ernst & Young are just accountants, tax, one of the big whatever they are now. And check what their advice is, and then look at the actual IRS reg to make sure you're legal. The internet, nah. I mean, you can maybe get some quick guidance, but usually, what you pay for that advice is usually worth it. I mean, you gotta love internet things that I really don't know, but and then they go on to they've already told you they have no credibility. They don't know what they're talking about, but then they go on to rant for a bit about what they don't know about. And tax preparation software companies, you can do that, but keep in mind, I've got some friends, and I don't want to badmouth my friends, but they've worked for some of these, what is it, Jackson Hewitt and H&R Block, and they were like seasonal hires, and I wouldn't trust those guys to do my taxes, nor would I if I got audited. I mean, where are they going to be? They were like a seasonal hire. I'm not a big fan of that. So I've used professional like CPA things when it was real confusing, or people who do it as a year-round tasks. That's probably all right. And then lately I've just been using the online type stuff. But if I need to follow up, I'll follow up with a professional. But I'm not a big fan of some of the temporary things that pop up around tax time. Electronic filing, yeah, not a big deal. If you have one of the online type things, they will file for you, and yeah, you can do the free. Well, you can do it directly with the IRS. You don't necessarily need to avoid a third party if it's just a simple return. So, anyway, for most cases, if you can e-file, much better. Get your return quicker. Hopefully, you aren't waiting on your huge refund check because, like I said, you've screwed up if that's how you've run things. You should, maybe get a little bit of money back, but it should not be woohoo type thing. And don't do one of these they're basically payday advance loans where they give you an instant refund. Actually, what they do is they give you a loan on what your expected return is, but it's whatever. That's not a good deal. Those people they're not on your side. Tax preparation services. So accountants, attorneys, I don't know that we need to jump to attorney for all but a few cases, but I would look for people who do it, and you may not even have to jump to a CPA. There's actually tax people who do this job year round, and so there's some accountability. If you get audited, yeah, actually the odds of getting audited go down and further. There's most of the online type things, depending on your situation, will actually give you a sort of a idea of what your audit risk is based upon some of your accounts. They're going to try and stick with primarily kind of big fish kind of folks, and then they'll go out there for maybe a random audit on the rest of us. But if you haven't done anything flaky, you've got nothing to worry about. So again, take the deductions that you're entitled to, and but make sure you're certainly entitled to them. Tax avoidance. So like I say, rats chasing government cheese. You are gonna do it's all pseudo manipulation by the government, trying to get you to do certain things or invest in certain ways and do all that kind of stuff. And it's legitimate. Now, tax evasion, yeah, that's not paying the taxes or hiding income, doing things like that. So don't go there. Again, if you're doing your taxes early enough in the year, you can employ these strategies, accelerate deductions. So if I had a friend, he was military and he was getting out, going back to grad school. Well, his income was going to go from being reasonable to almost nothing when he's a grad student. So what you wanted to do was you wanted to try and get any income and push it forward into that next year when you're not going to be working. So that's delaying the receipt of income. Accelerate deductions. If you know something's going on with the tax rate where they're talking about increasing taxes or something, you may want to change things around. So receipt of income, a higher tax rate next year. So all these different things you can do if you still have time within the tax year. If you waited beyond the 1 January, you're stuck. Other than maybe put money in an IRA, but other stuff, selling stock or selling investments, changing things around, changing income, it's not easy to do. Mortgage interest, that is the greatest thing going in terms of the deductibility of that. If they take it away, some people consider a loophole. It's going to kill the real estate market, and also it's going to kill a lot of investors, a lot of just homeowners, because that's a huge deduction. And we'll go through that between renting and owning a home. But if you own a home, it's from a tax standpoint, much better. Home equity line of credit, yeah, if you can get it some way that it's tax deductible. Normal consumer debt like credit card stuff, not deductible. Homeowner debt is. So, job-related expenses, again, you got to look at what the guidelines are. But if it's involved with job search, moving to a different location, all that stuff, there's limits, there's mileage, there's all kinds of different stuff, but a lot of it's deductible. And then exempt investments, mutual bonds, it's not as easy, or municipal bonds, munis. It's not as easy as it sounds. In fact, we'll have an example on your homework where you get one interest rate if it's municipal bond, or a higher interest rate if it's a taxable bond. So those things are often factored in there. It depends on your situation, but bonds in general, I'm not a big bond person, because bonds, as interest rates go up, they become a crummy investment. And we'll talk more about this as we go. And right now we've got historically low interest rates, so bonds, with the odds are that interest rates are going to go up here in the future, they're not an attractive investment. So tax exempt investments, so we just talked about that. Treasury bonds, not a big fan of that, just not enough interest involved. Tax deferred annuities, depends on what they are. Tax advantage, tax deferred, those are critical. And again, if there's some employee sponsorship in there, a matching thing where you put down a couple percent and they put down the same percent, well, that's like increasing your salary. So you need to find out what that matching level is and make sure at least you're hitting that amount. And again, this gets back to this whole cafeteria type thing of employee benefits. So you want to make sure that things you have control over, you're going to take care of that. Long-term capital gains, self-employment tax, children's investments, education. So, if you sell a home, lived in it 3 out of the past 5 years, that is, again, a huge windfall for people who own real estate, because you can get that money back tax-free. It's one of the few times you can get something on a basis like that. We've got some sort of critter out here in the woods behind me, but we'll figure it out. Self-employment tax. So that's Social Security, and then children's investments, income shifting, and then educational IRAs. So again, different tax strategies. 529s, education type things fall into the strategy too. So we'll look more at that as we get into subsequent chapters. Retirement plan. I've talked a little bit about this. Traditional IRAs, Roth IRAs, and Keogh plans. Again, each one is different in terms of the tax advantages, but they're all designed to take part of your income and put it into a lower tax bracket. So if you're that should actually be a 403B there. An educator, those are 403Bs, and TSP, the military variant. And what's happening though is, the time when you used to work for a company and you just walk in the door and they say, this is our pension plan, those days are largely gone. So you have a lot more flexibility, and most of it's self-directed. So, if you're smart, it works out. If you're not, you're going to get penalized. So here's the homework. Again, this one is a little more complex, not in terms of the problems, but the way they've got it done. I've got the 10th and the 11th edition numbers in there. And then on here, they actually had the problems slightly different in terms of the numbers, but do either one and turn it in on the assignment section. So anyway, I apologize for this sort of inconvenience this week, but I hope we'll be able to keep up to speed. And if you have any questions, please let me know. I'm not going to be gone too awful long. I'm trying to get back as soon as possible, so I may be back perhaps even by Thursday afternoon. So look forward to talking to you then. And again, if if you're in the area, my office hours are always there, and whether it's a email or even text messages, stuff like that. No problem. Just get a hold of me if there's some confusion out there. Look forward to next week. Thanks.